How's it going? I'm Andrew with Investors Hub, and real quick introduction. We're talking with Clem Chambers. He's the CEO of ADVFN. He's my boss. We're going to be talking about the Bitcoin ETF. We're also going to be chatting about Ethereum 2.0. And finally, we're going to talk a little bit about that proposed rule with the IRS snooping on everybody's bank accounts all the time, and maybe how that relates to cryptocurrency. So yeah, if you like the video, please be sure to like, comment, and subscribe. You can follow us on Twitter at ihub_vision. And yeah, after a quick disclaimer, we'll hear from Clem. Please note that our videos are not designed to be direct investing advice. Our channel and our content should just be one stop on the journey of trying to find out where to put your money. So Clem, they recently released the Bitcoin ETF. Now, why would someone be interested in investing in a Bitcoin ETF rather than just buying some Bitcoin from Coinbase or wherever?
You used an interesting word there, invest. That ETF is not for investment because it's a ETF that uses the future. And the future's value is always decaying. And a future that actually is turned into an ETF doesn't track very well because the ETF provider has to buy a near contract and keep rolling it. And because there's something called contango, it means that its value drops because you're buying it at a higher price in the future, and as time passes, that value drops. So if you keep buying, say, 2 contracts out, and then as that contract decays, you buy the next contract out and sell that one, you're always losing a little bit of a percentage every time you do it. If you do that enough for enough years, it goes to zero. Okay, so why would you make an ETF that was based on a futures contract? Because from day to day, it tracks really well. It's only going to lose 6 or 7% a year. Well, 5 years, that's a big chunk. So you don't invest because over 4 or 5 years, you're going to lose, large percentages of your upside purely because the future is decaying and has the contango thing going on with it. However, if you think Bitcoin is going to go to the all-time high today, it did, then you would buy that ETF because you could go into your I'm not sure whether you can put it in your K's pension funds, but you can go into the market through your broker and go buy yourself some fake Bitcoins and sell them for a profit if it goes up. And if it goes down, well, you've lost money. Can I use the word gambling without being too insulting? It's a method to gamble on Bitcoin. Now, of course, one of the things is that people who play that over the short term, well, in the short term, they're going to lose their cost of transaction because unless they know which way the Bitcoin is going, then they're going to be right half the time, wrong half the time, and they're going to lose their cost of gambling. Yeah, well, if you do that long enough, and then you add in the ETF cost of it being an ETF, and then you add in the cost of the contango, you've got a house game, like in any casino, where the odds are against you. So you're going to lose, aren't you? So if anybody goes in there and go, I'm going to buy the Bitcoin, this is where you make money, I'm going to long-term invest or I'm going to trade, they're going to lose money, and then they go, I don't think much of this Bitcoin thing. So cynics might say the reason they've allowed for a future-based Bitcoin ETF is because they want a load of people to lose money on the Bitcoin and then think it's not such a great idea.
So it sounds a little bit like UVXY, which is a volatility index, right? That
has the same problem.
Yeah,
it's a tracker that doesn't track.
Yeah, it runs based on like futures contracts and the SPY and stuff like that. So
well, this is the whole problem with financial services, why they've got such a bad reputation and why there's so many scumbags there. Because the ETF was designed based on the work of the guy that wrote The Random Walk Down Wall Street, which was saying that you can't outperform the market because of the random walk. And if you've got these expensive fund managers who basically have no better clue about things than you have and don't perform any better than a monkey throwing whatever poo at a page of the Wall Street Journal, you're better off with a ETF, a fund that is the index, and you just buy that, sit back, and buy and hold it and forget about it. And that's the whole idea behind ETFs. Now, that is a fundamentally a benign structure because you get the full cost and the full value of the whole market without doing anything apart from paying a little bit of fees to a fund manager who doesn't take many fees. And you just sit there and you get all the benefit on the basis that nobody can really share stock pick and nobody can time the market, and the ones that do are just lucky and the ones that don't are unlucky. And forget all that, just buy the American index and sit back and enjoy. And it works. And because it works, people go, it works, I'll have some of that. And more people do it and it works and they keep doing it and ETFs become a thing. And then people come along and go, yeah, we got an ETF. It doesn't track. It's not the whole market. And by the way, it's going to lose your money. It's not an ETF. I mean, it is an ETF, and they're going to call it an ETF, and the regulators are going to say that's an ETF, but it's not what ETFs were when they were created, and not what they're for, and these toxic instruments are piggybacking on a benign instrument that is actually righteous and will make you money. And it's like renaming a serial killer Saint Serial Killer. But he's a saint. He's a lovely person. He's going to kill you, but he's a lovely person. Yeah. So it's typical of Wall Street and financial services. Those guys get fined billions of dollars every year, year in and year out. That they take a benign idea that's profitable for the customer and distort and warp it so that it's a toxic product that will rip the face off the customer and make them the poorer and make them the richer. And that's the sad, sorry state of financial services in the West, and well, everywhere you want to look, which is exactly why crypto, even for all its criminality and fraud and danger and risk and bugs and all that nonsense, is so popular, because it doesn't involve basically, going out for a date with a serial killer. It's doesn't have those people institutionalized as, oh, we're your friends, come and buy our Bitcoin ETF. It's only going to take all your money and hurt you. But we're nice people. We're in the industry. We're regulated, We are, yes, we're regulated. Oh, we've been fined another $1 billion for being naughty. Oh, no, how naughty of us. And, that is part of the tension between Wall Street and crypto. I mean, Wall Street is a bag of thieves, right? And you could say, well, you can't say that about Wall Street today. Well, you could say about Wall Street yesterday and the day before and the day before that, and all the way back to the 19th century. And, that makes them, in a sense, well, very rich in one hand and fragile in the other. Because if any better alternative shows up that they don't control, then, people are going to veer away from them. And that's what's happening with crypto. Because DeFi, they're not there. There's all sorts of risks in DeFi, all sorts of problems and troubles and costs. But there's not some spider in the middle of the web coming up with a nice idea to part you with your cash and ask you to thank them for it.
So switching gears a little bit, the Ethereum 2.0 rollout in terms of the switch to the proof of stake system is supposed to happen sometime in the beginning of next year, right around that time period. They just had a meeting on October 15th, and they've posted some notes about that. So I know that you are sort of the top dog in a cryptocurrency project that is facilitating transactions to layer 2. That's its primary function. How do you think that layer 2 solutions will work in the proof of stake system? Is proof of stake going to take market share away from those layer 2s?
No one knows the future in this area because the horizon of opportunity is so broad. No one can possibly know what's going to happen next. And the risk profile is not even a profile, it's a surface. It's a multi-dimensional risk surface. It's so wide, anything can happen. Now, one thing, let me tell you what could happen with Ethereum. And then you tell me whether you think this is likely. So obviously, they're going to finish all the technical work at the beginning, first quarter of next year. And they're going to roll it out, and it's going to be perfect, and nothing's going to go wrong, and everything's going to be great. And it's going to do exactly what they say it's going to do, and it's going to go exactly to plan, and there's going to be no surprises and shocks, and there's going to be no bugs, and it's going to do exactly what everybody's expecting to make the world a utopia. You think that's going to happen? That's what they're planning. But the chances of that happening are exactly 0.00001, because that's not how software development works. I mean, Microsoft can release a whole 2 years worth of operating system idea, release it, and everyone goes, this is terrible, we don't want it. And they have to take it away again and put back the blooming desktop. And that's Microsoft with 1,000 developers or 10,000 developers. Who knows how many legions of developers they've got. Software just doesn't work like that. So yes, they will finish at some point. Yes, it will break. Yes, it won't do what they expect it to do. Yes, it won't have the impact that they were planning. It will have a completely different impact. And yes, it will be, there'll be swings and roundabouts. There will be ups and downs, and there will be glitches galore, and there will be surprises uncountable. And with a bit of luck, it'll be great. But it certainly will not be smooth, and it certainly won't be soon. Oh, depending on how you define soon, of course. It's going to be later. It's going to not work as expected. There's going to be things that are great that's going to happen because of it, and there's going to be things that aren't so great that are going to happen because of it. When they did the London fork, yeah, it's meant to bring transaction fees down. They basically tripled. Yeah, so okay, they tripled. Oh well, Ethereum's gone up 25% since then anyway. But nonetheless, the whole point of that, one of the points was to bring your transaction fees down. Well, they'd gone down a lot, and as soon as they did it, they went up through the roof. So unintended consequences, at the very least, is what is to be expected. Timely release? Software as complicated as Ethereum? Never. It'll be a miracle. Could happen. No bugs? Could happen. No glitches? Could happen. Unlikely. It's a massive, massive upgrade of the most fabulous complexity, done by probably one of the smartest teams on planet Earth at the moment in far as software development is concerned. But for it to be on time and to do exactly what it is planned to do in exactly the right way and have only benefits that are desired, extremely, extremely unlikely.
So if you go on the front page of the ethereum.org website, at the very bottom, they mention that given the success of layer 2 scaling solutions, that they've sort of shifted their focus away from the sharding aspect of the Ethereum blockchain, which was something that was going to be coming after the proof of stake system anyway, I believe. And that was the system that was designed to sort of split the Ethereum blockchain into different rivers and make it run faster. But since layer 2 solutions are kind of already doing that, then they wanted to focus on their proof of stake system. So my sort of theory about cryptocurrency and about Ethereum and its relationship with its tokens is the fact that it's an ecosystem that they want there to be stability, and they don't want to shake everything up too badly. So given the fact that these layer 2 scaling solutions are becoming so popular, is that if Ethereum all of a sudden said, you know what, let's just cut you guys out of the game entirely and just make Ethereum way faster and pull the hands out of the cookie jar, then they would be destroying all of the stuff that people in the cryptocurrency world have already invested in, which would cause chaos, and then it would cause people to lose trust in Ethereum and all that stuff. So I think that Ethereum has sort of a market interest in maintaining stability in its own ecosystem.
Well, the way that I see crypto is well, if you look at the internet, it's computers plus communication. If you look at all the wonderful productivity tools, it's computing plus productivity. What is crypto? Crypto is computing plus politics. It's a way of encoding politics. Code is law, etc., etc. So a blockchain is basically a political structure. Political structures don't tend to like competing political structures. So, is a layer 2 blockchain? Is it actually layer 2 at all, or is it just layer 1? Yeah, is all these alternative layer 2 structures, could they replace Ethereum entirely? The answer is yes.
To say that, for example, if Polygon or whatever decided to really pop off and get extremely popular, who's to say that Polygon doesn't become the new layer 1, right? And then everybody else is building on top of it.
Yeah, exactly. So I don't believe that anybody is going to be embracing of this competition. And so, if they we'll see. Remember, Ethereum's going from proof of work, which is an anarchistic model, to proof of stake, which is an oligarchical model. So they've actually turned the clock back from the idea of distributed decentralization, and they've turned it into centralization. Yeah. So they've made a move away from the all unpermissioned, anybody can enter, anyone can play, and they put barriers up. Now you've got to come up with a fairly large amount of money before you can come to play. And of course, as they're getting the money, there's going to be a concentration of authority there, and there's going to be a centralization of Ethereum, or you can make that case anyway. So if you look at the political direction that they're going, it's of the people in the castle taking more and more control, not letting it go, cutting out the miners, cutting out the peasants. Yeah, so it's getting more and more oligarchical, getting more and more aristocratic and regal as time passes. Well, that's not going to turn around, because obviously people within that political group are looking at it going, oh, we can use that money.
I can see your argument that things could move towards a more oligarchical system, but proof of work in itself is oligarchical in the sense that you need an enormous amount of capital in order to invest in all of the machines that you need and the electricity.
No, that's not how oligarchs work. Oligarchs get into a position of power and they get given resources and they just sit there and they receive. That's how aristocracies work. The aristocrat doesn't go around applying lots of capital. He doesn't go around working really hard. His peasants do that for him, and they bring him their output, and he takes it and gives some back to them. That's how it's worked since the beginning of recorded history. And that's what aristocrats, oligarchs, same deal, do. Magnates, they used to be called. Yeah, and you sit there and passively earn. Ring a bell? Proof of stake? However, if you actually have to do the work, you have to make more and more bulldozers to move that mountain. You just don't send the pharaoh just doesn't send slaves out to start, chipping it down with their bare hands. Then that's proof of work, and work equals success. If you don't do a lot of work, if you don't do great work, if you're not fighting everybody else trying to do work in front of you, you don't succeed. Your success is down to work rather than your position within a political structure.
So as a last topic for our conversation here, so here in the United States, there's big controversy about this proposal from the Fed and Yellen, is that they would be monitoring the ins and outs of all bank accounts that had $600 in transactions. It was a very low threshold. And then recently, the news articles have been coming out within the last 12, 24 hours that they've since bumped that up to $10,000, and that they're not including people they're not including employment wages and stuff like that. I'm still incredibly skeptical of the whole arrangement, even though this is sort of a step in the right direction. So my question, and we're going to keep things focused on cryptocurrency, do you think that this aggressive monitoring of bank flows in and out is an attack against cryptocurrency?
It's all about tax. Yeah, and they're going to have to do a lot more of that. And the best way to do tax is to create inflation, because inflation is a tax, and everybody gets taxed with it, and most people can't even work out it's happening. You don't have to fill in any paperwork. Most people are innumerate, so they don't see it. They go, oh, that got a bit more expensive, but they simply do not have the training to track it. And maybe they got paid more, maybe they feel richer because they've got a 20% pay rise, even though prices went up 30%. And so if you're going to look, at the end of the day, America is broke. At the end of the Second World War, it had all the gold, it had all the money, it had everything, and it's dissipated that through various policies. And it's now borderline broke. Yeah, a lot of people think it's totally broke, but it's not as rich a country as it was in the past. It's not the dominating Goliath surrounded by dwarfs anymore. It is being matched by Europe, it's matched by China, and pretty soon be matched by India. Yeah, it's a country with financial problems right up to here. Yeah, so where's it going to get the money from? Well, no one's going to give it to it. It's going to have to take it from its asset base. And that's you, mate. So the last thing in the world they need and they're going to allow are any escape hatches. Right? So it doesn't matter whether it's called crypto. It doesn't matter whether it's called gold. In 1933, they confiscated everybody's gold because people needed an escape hatch and it was going to be gold. So what happened? They came around, put a gun in people's face and said, give us your gold. You're not allowed to have it. If you have gold, we're going to put you in jail, because gold was an escape hatch. So you got to stop that. You got to close down all your escape hatches, haven't you? And the best way to do that is track everybody's money. So when they run for an escape hatch with their cash, you can say, stop that. You're putting that over there, aren't you? No, no, no.
Well, the most extraordinarily insulting thing about the entire affair, to me at least, is that they're sort of hiding their movements under the veil of taxing the rich, right? Which is a popular standpoint to have. And so they're saying, oh, no, 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 we're just going to tax the rich. But it reminds me a bit of like saying, okay, we're going to stop all reckless driving on the roads by automatically shutting off the cars of every person driving over 65 miles per hour. Or at least not shutting them off, but automatically ticketing everyone that is driving over 65 miles per hour. The answer is, yeah, I mean, you might probably stop.
There are countries that do that.
Huh?
There are countries that do that.
Yeah, it's really it's a pretty extraordinary measure, and it's even better, right? Is every time I see Yellen quoted, right, explaining sort of her position on the bill, she says, "Well, imagine a bank account that they've only reported $10,000, but they've had $3 million go in and out of the account," and everyone's kind of looking at each other. It's like, yeah, I mean that makes sense, but that's kind of a terrible example, right? The issue is not the one.
It would be a good example, but then they'd have to change their variables, wouldn't they? They'd have to say anything with £1 million or $1 million. But the point is, the reason they don't teach finance to young people is that they might learn about it. Yeah, tax doesn't come from the rich. Tax comes from the poor. Yeah, the tax base comes from the poor. And if you look at the American budget deficit, I think some ridiculous number like the government expenditure is way, 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 way over. The deficit is way more than is actually collected in income tax. Yeah, it's the other thing to think about tax. Okay, so here's a politician. They go and say, well, we've got these policies. They're going to cost X. Okay, and therefore we're going to tax you to pay for those policies. Okay, fine, good. You might agree to that. But what they actually do is we're going to tax you as much as we can in every single way possible and get as much money out of you as we can. And then we're going to spend it. And then, because that's not going to be enough, we're going to spend more. They tax up to the max and then they spend more. They don't tax up to what their policies need unless they've got some pretty crazy policies. They tax as much as absolute possible and then they spend it. Yeah. And you can see that basis means that taxes, it's all just a gag. It's a gag for the public sector to pull resources from the private sector. And as you can see, when you look around, you look at public sector people and their terms and conditions, and you look at private sector and their terms and conditions. They're a world apart.
Thanks so much for watching. And if you hadn't already, please be sure to like, comment, and subscribe. You could follow us on Twitter at ihub_vision. And I'll see you again soon.